Assalamualaikum and have a good day everyone. We are from Group 5 and today we'll be presenting about accounting for property development. Here are our team members. It consisted of me, Najwa Farhana binti Jalil, Nurul Nadia binti Saman, Nur Fatihah binti Muhammad Faizal, and lastly Nur Nadia binti Latif. For question 5, we choose to explain how conceptual framework is helpful in solving the accounting for property development. From this question, there are some arguments that the development of a conceptual framework is inappropriate because accountants constantly deal with specific issues that will not be desirable in future by an overall general conceptual framework. In particular, the accounting conceptual framework makes no allowance for differences in the social context where accounting is applied. They also argue that it would be preferable to develop case-specific solutions to accounting issues based on case study research and bearing in mind the social context of all accounting decisions. Now, I will explain what a conceptual framework is. The accounting conceptual framework is a set of accounting objectives and fundamentals which is developed by the International Accounting Standard Boards to ensure uniformity in interpretation across various accounting methodologies. It helps the board in setting sound financial accounting standards and helps members of the board's constituency not only understand and apply those standards but also contribute significantly to their development. The conceptual framework is not a standard. Nothing in the conceptual framework overrides any standard or any requirements in a standard. It does not establish new accounting standards or change existing GAAP, but it is a foundation in establishing new standards or amending existing standards. Next, I will explain the purpose of the conceptual framework. There are three main purposes. First is to assist in the development of future IFRS and the review of existing standards by setting out the underlying concepts. Second is to assist preparers to develop consistent accounting policies when no standard applies to a particular transaction or other event, or when a standard allows a choice of accounting policy. This is to promote harmonization of accounting regulation and standards by reducing the number of permitted alternative accounting treatments. Third is to assist all parties to understand and interpret the standards, which means it assists the preparers of financial statements to understand and help them in the application of IFRS, which will include dealing with accounting transactions for which there is not yet and accounting standards. Before I explain why conceptual framework is important, I will explain some serious defects produced by accounting standards during the absence of conceptual framework. First, they were not consistent with each other, particularly in the role of prudence versus accruals or matching. Second, they were also internally inconsistent and often the effect of the transaction on the statement of financial position was considered more important than its effect on income in the statement. Third, standards were produced on a firefighting approach, often reacting to a corporate scandal or failure rather than being proactive in determining best policy. Fourth, some standard setting bodies were biased in their composition, meaning it is not fairly representative of all users group, and this influenced the quality and directions of standards. Fifth, the same theoretical issue were revisited many times in successive standards. It could be claimed that the lack of a conceptual framework has resulted in the rise of rule-based accounting system, the key objective of which is to process all accounting transactions according to detailed specific rules or standards. Although such a system is rigid and prescriptive, it offers the advantage of making financial statements more comparable and consistent. The availability of a conceptual framework, on the other hand, may lead to a principle-based system in which accounting standards are formed from an agreed conceptual framework with specified goals. Now, I will explain why the conceptual framework is important. First, accounting framework helps a better understanding of accounting information. This framework aids financial reports users in understanding the data contained in financial statements prepared in accordance with financial accounting standards. Second, it directs future financial accounting standards development and regulation of management subjective judgment while generating financial statements and other financial reporting. Third, for investors, a conceptual framework is vital. This is because it provides the risk capital to investor and the advisor is concerned about the risk associated with their investment. The information is required to assist them in deciding whether to sell, purchase, or keep the shares. While the shareholders are interested in information that allows them to assess the company's ability to pay dividends, employees and their representative groups are also interested in the company's capacity to provide retirement benefits, job prospects, and remuneration, as well as information that allows them to assess the company's ability to do so. Next, I will explain about the limitation of conceptual framework. The first one is that it is very difficult to set up. It takes time and costs a lot of money to establish a conceptual framework. Time-consuming may become the limitation of the accounting conceptual framework. Developing countries may not be able to afford to develop an accounting conceptual framework. Second, it may lead to rigidity. The concept of conceptual framework is rigid and encouraging. Incorporating new ideas to it is difficult. Third, there is always a conflict between previously developed accounting standards and conceptual framework. Other prior established standards sometimes differ from the basic principles of conceptual framework. Lastly, conceptual framework may not be acceptable to every party. The opportunity that a conceptual framework provides may benefit only some of the users. The framework cannot always be workable or acceptable to all parties. I will pass to Fatihah Faizal to explain about the property development.
Thank you, Najwa, for the great explanation on conceptual framework. Hi, my name is Nur Fatihah, and now I will continue the presentation on the property development. Property development refer to the business of acquiring land for the purpose of first, construction thereon and selling completed residential and or commercial and industrial buildings, whether as a whole or by parcels therein. And second, for development and sale of vacant lots for the construction of such buildings thereon, including homesteads, hobby farms, orchards, or for other similar purposes. Now, I will present on property development activities. According to FAR661, property development activities are defined as activities involving the necessary steps to plan and construct and comply with statutory and contractual requirements in the development of land into vacant lots, residential, commercial, and or industrial buildings. Moving on to the next slide, I will explain on the nature of property development activities. An entity that engage in property development activities, in example, a developer, acquires land develops the land into properties, and sells the developed properties. To such an entity, land under development forms its stocks of trading assets. The nature of its business consists mainly of acquiring of land for the purpose for development, such as constructing houses or office buildings, selling completed residential and or commercial and industry buildings, whether as a whole or by parcels therein, and the development of vacant lots for sale. The development of land for sale is usually staggered in phases such that each phase constitutes an identifiable project for the purpose of monitoring costs and revenues. FAR661 defines a project as a cluster of development units erected within a designated geographical area forming a cost accumulating center. Within each project are the development units such as residential, commercial, industry buildings, and or vacant lots developed for sale. Moving on to objective and scope of property development activities. The objective of this standard is to prescribe the accounting treatment for revenue and costs associated with property development activities. The standard deals with the basis for the classification and measurement of land for future development by property development entities. Next objective is to assist in determining the related revenue, expenses, and profit of property development activities. Scopes of property development is this standard shall be applied in the accounting for property development activities in the financial statements of an entity undertaking property development activities, which is governed by provisions of the Housing Development, Control and Licensing Act in 1966. Now, I will explain on land held for property development. Land held for property development shall be classified as non-current asset when no development activities have been carried out or when development activities are not expected to be completed within the normal operating cycle. Land held for property development shall be carried at cost less any accumulated impairment losses. An entity shall apply Section 27 Impairment of Assets to determine whether the land has become impaired. The change in the classification of land held for property development to current asset shall be at the point when development activities have commenced and when it can be demonstrated that development activities can be completed within the normal operating cycle. Property development entities, particularly those listed on the Bursa Malaysia Exchange, often acquire large land banks with the intention of undertaking development activities over a very long or indefinite period of time. As property development activities are normally staggered in phases or projects, there would be regular reclassification of non-current land or portion thereof to property development project cost, which is a current asset as and when development activities commence. When development activities are carried out in phases over a large tract of land, the cost associated with the land acquisition or the carrying amount for that particular phase or project shall be apportioned with the area of the land currently under development to the total of the land. In a single acquisition of a large of land, the land is, or assumed to be, acquires at a uniform for the whole area. It is therefore appropriate to apportion the acquisition cost or the carrying amount on the basis of the area. Now, I will explain on the difference between property development activities and construction contracts. The accounting principles for property development activities are set out in FAR661. AMPERS covers this area in Section 34, Specialized Activities, and has requirements that are identical to those in FAR102 and for construction contracts under MFRS 111. In general, the issues center on identifying and recognizing development activities by phases of property development projects, measuring the cost to be accumulated to the property development projects, measuring the revenues of the property development projects, determining the amount of revenue and expenses to be recognized in each reporting period, and presenting the required disclosures in the financial statements. However, there is one main difference between construction contracts and property development activities. In construction contracts, the contractor entity does not have ownership of the physical asset under construction. The asset under construction belongs to his or her customer as he only provides a construction service to earn the agreed construction revenues. Accordingly, a contractor recognizes a receivable or payable which is amount due from or amount due to customers based upon the performance of the construction service rendered to date. In contrast, a property developer retains ownership of unsold units for an undefined period. Accordingly, a property developer recognizes property development work in progress, which is synonym with stocks in progress, as an asset during the development stage of a project until the units are sold. That's all from me. Now, I will pass to the next presenter, Nurul Nadia. Thank you.
Thank you, Fatiha, for your great explanation. Now, I will continue to explain regarding the components of recognition of the property development. There are 5 different components related with this topic. Let's look at the first component, which is land held for property development. The standard prescribes that land held for property development shall be classified as non-current asset where no development activities have been carried out or where development activities are not expected to be completed within the normal operating cycle. The land held for development may be presented under operating assets immediately after the property, plant and equipment line item. It further describes that land held for property development shall be carried at cost less any accumulated impairment losses. An entity shall apply MFRS 136 impairment of assets to determine whether the land has become impaired. A significant change introduced in this standard is the removal of the option to carry land held for development at revalued amount or at fair value. The change in the classification of land held for property development to current asset shall be at the point when development activities have commenced and where it can be demonstrated that the development activities can be completed within the normal operating cycle. For instance, a leasehold land classified as a property, plant and equipment will normally be amortized over the lease period, whereas a leasehold land held for property development is not subject to systematic amortization. Second, we go through the component of property development costs. FRS 201 prescribes that property development project costs shall comprise all costs that are directly attributable to development activities or that can be allocated on a reasonable basis to such activities. The cost accumulated to a property development project shall be recognized as an asset, essentially a work in progress in the SOFP. As and when units are sold, a portion of the cost based on the stage of completion is transferred and recognized as an expense in the income statement to match it with the related project revenue. FAR661 also stated that costs relating to property development activities can be divided into costs associated with the acquisition of land, which include the purchase price of land, conversion costs, and incidental costs such as stamp duties. Related costs incurred subsequent to the acquisition of land can be capitalized only when there are development activities in progress. It also can be divided into costs related directly to a specific development activity, which is during the construction stage of property development, such as professional fees and contractors' costs for building works. Lastly, the cost divided into costs attributable to the development activities in general can be allocated to the project include common infrastructure costs, such as costs that will be allocated to existing and future property development projects within the geographical location, and costs that will be allocated to all projects currently in progress in various locations. Next, we move on to another component of property development, which is the property development revenues and expenses. The standard stated that property development revenue shall comprise the selling price agreed in the sale and purchase agreements and any additional revenue due to variation in development work. Hence, property development revenue shall be recognized in respect of all development units that have been sold. The standard basically requires that when the outcome can be estimated reliably, such revenue shall be recognized in profit or loss by reference to the stage of completion of the development project. Moreover, the revenue recognition commences when all the criteria are met, including when the sale of the development units is effects upon the commencement of development and construction activities, and when the financial outcome of the development activity can be reliably estimated, if only all the conditions are met, such as total revenue can be measured reliably. It is probable that the economic benefits will flow to the entity. Both costs to complete and stage of completion of development project at the balance sheet date can be measured reliably, and also the costs attributable to the development activities can be clearly identified and measured reliably. Meanwhile, the standard prescribes that when property development units are sold, the attributable portion of property development costs shall be recognized as an expense in the period in which related revenue is recognized. It further stated that property development revenues and expenses shall be recognized in the income statement when the outcome of a development activity can be estimated reliably. Then, as for the components of estimates, revocations of sales, and incentives, the standard requires that estimates and cost allocations shall be reviewed at the end of each financial reporting period until the project is substantially completed. Costs shall be revised and reallocated where necessary for any changes on the basis of current estimates. The effects of change in the accounting estimate shall be included in the determination of net profit or loss in accordance with MFRS 108. As a result of uncertainties inherent in property development activities, cost and revenue estimates cannot be measured with precision. For a property development project, the effects of cost revisions are applied prospectively in the current and future periods until the project is completed. Also, the standard requires that project development revenue and expenses recognized shall be immediately written back as soon as a revocation of sales occurs. The effect of this requirement is that profits previously recognized on units sold are to be immediately written back as soon as revocation of sale occurs. When sales incentive or other guarantees are offered to induce sales, the estimated obligation under such incentives or guarantees are accounted for in accordance with MFRS 137. It is common practice for property development entities to offer incentive to entice buyers. The incentives may be in the form of a developer's guaranteed occupancy of the development units or guarantee return on the purchaser's investments for a specified period. Uncertainties exist as to the extent that purchases would allow the entity to manage on their behalf, demand for rented properties, and amount for rental chargeable. Under such situations, it may be difficult to estimate reliably the obligations to be undertaken by the entities. Other incentives or promotional costs incurred by the property development entity that are associated with the sale of its development units shall not be capitalized but are to be recognized in the income statement. Lastly, it relates with the inventories unsold completed development units. The standard requires that inventories of unsold completed development units shall be stated at the lower of cost and net realizable value. Unsold development units are basically inventories, and accordingly, the measurement principle of FAR661 inventories shall apply. Therefore, development units that are retained by the property developer as management office or investment rental units shall be accounted for in accordance with FAR116 property, plant and equipment or FAR140 investment property respectively. That's all from me. Now I will pass to the next presenter, Nur Nadia.
Thank you, Nur Nadia, for the great presentation and explanation. Okay, next, I will present to you the benefit and drawback of the conceptual framework. So, why this conceptual framework can be helpful for property development? We will describe it on terms of MFRS and MPER standard because those were developed based on the same framework, which is the conceptual framework. As explained before, this conceptual framework assists MASP in development of future standards such as MFRS or MPERS and its review of existing standards. So, on MFRS, it is helpful for property development because this standard addresses the property development properly as there are specific issues. Those issues include like accounting treatment when only one unit of property sold, which the developer need to estimate the stand-alone price of the property. Also, allocation of common costs for different projects such direct or fixed costs to assist in the decision-making process. Another issue is the computation of percentage of completion that used if the revenues and costs of a project can be reasonably estimated. This method is subject to fraudulent activity, which is usually to overestimate the amount of revenue and profit that should be recognized in the financial statement. While for MPERS, it is helpful when dealing with specific issues. Based on the case study on framework related to COVID-19 by Ayuni and Nazlia, it helps the developers to organize their operations smoothly that meet the requirement needed due to the characteristics such relevance and timeliness in the standard and conceptual framework. The case study also stated that it is of useful information if it reflects the relevance event occurred at that time. Furthermore, MPERS also is a less rule-based standard, which means that even you have applied the wrong judgment on your reporting, you still can argue it out depending on the circumstance and situations. Besides, it provides greater flexibility in the property development decisions since the company can choose the best method or policy that suit the requirement and based on the circumstances. However, this framework might also not be helpful for property development. As for MFRS, it is stated that if there is uncertainty inherent in the property development activities, the cost and revenue estimates cannot be measured without possessions. So, without a proper possession cost estimated to both ongoing and future projects, it is not helpful as this estimation will not reflect the on-time event and situation. While MPERS might not be helpful on property development because there is no new standard regarding property development activities issued by MASP. Since then, after 1 January 2006, no new PERS has been issued. Between PERS and the new reporting standard MPERS, the gap is between 10 to 11 years. PERS framework has not revised to incorporate changes in the last 11 years, even though the MFRS has made significant adjustment, development and enhancements. IFRS and MFRS are always changed, but not SMEs. MASB released MPERS to introduce the improvements to small and medium enterprise, which is SMEs, and to see the quality of financial statements since the introduction. So, this showed that the standard between those years may not reflect on all uncertainty occur during the gap. Thus, it may not be helpful as the uncertainty event on the gap could happen again, but the new standard has not incurred or set by those events. So, as conclusion, the conceptual framework which basis of MFRS and MPERS standard are made with the flexibility to suit any situation and also uncertain event. However, those standards such MFRS is made based on the estimation which might not reflect the actual information, while MPERS might not reflect the event occur during the gap with the newer standard. So, in this case, the company might also need to construct their own property development framework based on their company's policy and procedure to follow up with the circumstance and meet the requirement. The company's frameworks will still based on MFRS or MPERS standard, but revised on their management and operations policy so it can be used with the significant changes of situation and circumstance. Based on case study of successful property development framework by Ivo Altona, it explained that we should construct a conceptual framework before we begin collecting data. The framework is constructed within our company's policy and internal control procedure that can illustrate our research for a successful property development. Therefore, any estimation made on uncertain event can be predicted and adapted by the company. However, even though the company already have their revised framework to follow with, the development of conceptual framework which the basis of MFRS or MPERS standard is still important to take into consideration. It is because the improved conceptual framework may assist preparers of financial statements in developing accounting policies for transactions or events not covered by existing standards. Due to that, company may not need to incur more time or cost to revise their own framework as the standard has been reflecting the events. This same goes to in developing case-specific solution to accounting issues. The case developed might be useful for companies or SMEs to adapt with current issue. It is because those case-specific solutions still in context of all accounting decisions referring to the standards such MFRS and MPERS, and it just be developed to fit into the case related to the issue. In addition, they also issued during 2014 and 2015, which there are some changes made to the standard MFRS 201. MASB has announced that this MFRS 201 of property development will be replaced by the new standard of MFRS 15 revenue from contracts with customer. Due to this, they might be quite challenging for the company, especially the developer, due to meet the requirement of the new standard. The company may face some difficulties such as need to incur more employee training for the new standard, additional disclosure requirement needed in their financial report, and also incur additional costs and etc. Fortunately, these difficulties could be adapted if the company ensures that they have appropriate system, internal controls, policy and procedures in place to collect and disclose the required information. So, answering to the question, this development of conceptual framework is appropriate since it can be adapted within the company's plan or policy, and it is also preferable to develop case-specific solution to accounting issue based on case study research and bearing in mind the social context of all accounting decisions. It is because it helps the company, especially accountants, to solve all the uncertain event or issue arise during that time. So I think that's all from us. Thank you for your cooperation. Next, we move on to the Q&A session.